Basic of stock market for beginners. Lesson number 1. What is an investment, and how long to turn a penny into $1 million, by Edward Cash Trader. Before we start, let's shake up our minds a little bit, with some interesting questions. Question number 1. How many trades in the stock market do you need to become a millionaire? Question number 2. Would you rather have $1 million today or a penny that doubles every day for the next 30 days? Question number 3. Would you rather receive $1,000 today or receive $1,100 a year from now? Question number 4. Would you prefer to drive a new car or invest in the stock market? Stay tuned, because I will answer all those questions, and give you some valuable information such as 1. A real-life example of a great investment, and how it worked for a bankrupt man in 1929. 2. The number 1 investor's most powerful secret. 3. How long it takes to turn a penny into $1 million. 4. How much you would have today if you had invested $100 in the S&P 500 at the beginning of 2009. 5. In the end, as a bonus, I will share an Excel sheet, so you can find out how many trades you will need to take to reach $1 million. If you would like to support us, at any time, feel free to smash the like button, and share with your friends all the valuable information you will receive. I will answer the questions backward to make it more interesting. Now let's dive in. Question number 4. Would you rather choose to buy a new car or invest in the stock market? This is the question I chose to start the beginner's course because it is a mistake most people make when they earn some extra money, thinking a car is an investment, but I will show you who actually wins in this type of transaction. Excluding some specific moments of economic expansion, such as after the last pandemic, from 2020 to 2023, the average new car will lose up to 60% of its value within the first 3 years of ownership, according to the website, WeBuyAnyCar.com. Depreciation refers to the difference between the price of a car when you buy it versus when you sell it. This may not seem like a huge factor when you purchase the car, but it will be when it's time for you to sell. Also, most people finance the car when they buy it, which means over the years, whoever buys a car pays a lot of money on interest. The average auto loan interest rates across all credit profiles, in the United States, range from 5.64% to 14.78% for new cars and 7.66% to 21.55% for used cars, according to the website MarketWatch.com. Therefore, who is making an investment when a car is sold? You or the company that sold and financed your car? I am sure you already know the answer. Still, we need to learn how advantageous it is to take that extra money and instead of buying a new car, buy a stock in the stock market. So, let's start with a picture. The car you see in this photograph was a 1929 Chrysler 75, sold, at the time, as new, for around $1,500. That would equal about $24,000 today. The $100 asking price after the crash would be somewhere about $1,600 today. Bankrupt, he tries to sell his luxury roadster for $100 following the 1929 stock market crash. Walter Thornton recovered quickly after the stock crash. He used the money to start a modeling agency in 1929. As the Walter Thornton Modeling Agency grew, it was considered one of the Big Three and one of the largest model agencies in the United States. The agency was known for its World War II era of pin-up girls. What happened was Walter chose to invest all the money he could in something that he knew would bring a lot more money, and even more than the $1,500 that he paid for the new car. There it is. This is the perfect example of an investment. For instance, if you decide to save $100 today and invest in yourself, doing some course, that could bring you a lot of money, from any business that you could create out of the knowledge you earned from the course. It is not about the car, actually. If you manage to buy a car cheaper and sell it with a profit, excluding all taxes and expenses, you made an investment. But if you think you will buy a car just for fun, do not expect to earn any money from it. That will only be counted as an expense. I know you can't drive an index fund or a stock, but what I am trying to break here is the misconception that buying a car is an investment. If you want to spend your money, that is fine, but what I am offering here is the option to choose to make an investment. If you need a car, you could just buy a cheaper one and invest the rest of the money. It will take you the same way to the same places, most of the time. Therefore, if you choose to invest, how much money could earn between buying a car and investing in the stock market? First, you need to understand that stocks are long-term investments, partly because it's not uncommon for their value to drop by 10% to 20% or more in the short term. However, by holding onto stocks for many years or even decades, investors can ride out these fluctuations and potentially achieve better long-term returns. If you are not ready to wait that long, try another type of investment, but you are ready for swings and high returns over the long run, then you could get in, with the help of a professional financial advisor. If you invested $100 in the S&P 500 at the beginning of 2009, you would have about $852.89 at the end of 2024, assuming you reinvested all dividends. This is a return on investment of 752.89%, or 14.92% per year. This lump sum investment beats inflation during this period for an inflation-adjusted return of about 481.73% cumulatively, or 12.10% per year, according to the website, officialdata.org. But, if you used dollar cost averaging instead of a lump sum investment, you'd have only $702.10. This is why, if you decide to invest in the stock market, you need to let it ride on the long term, and just add more as it goes. Dollar cost averaging is an alternative to investing the full lump sum of $100 up front. Instead, the capital is invested over a period of time. This short-term strategy, in which $100 was invested in the S&P 500, only for a short period, of no more than 24 months beginning in 2009, would result in a final amount of $702.11, including dividend reinvestments. Therefore, it is only worthy to choose the stock market instead of buying a car if you decide to make it as a long-term investment, otherwise, it would not make any difference. Considering that a $30,000 car today will likely be worth around $27,000 next year, and in 10 years, it could drop to about $10,460 or less, so in a long-term perspective, you should look towards the stock market. Because if you decided to invest the same $30,000 in the stock market, using an annual return of 12%, with the S&P 500 average, after 10 years, you would have $93,175, not to mention any dividend that you could reinvest, and make even more money, if you like. To summarize, the answer is, just learn how to invest, choose the type of investment you think aligns with your type of personality, and find a way of saving the money to start to invest. Either short-term or longer-term investment, the important thing is, if this is an investment, it needs to bring you profit, and the basic principle is, buy low and sell high. It does not matter if it is a car or a house or a stock, at the end you need to have more money than you began with, otherwise it was not an investment, but spending. Question number 3. Would you rather receive $1,000 today or receive $1,100 a year from now? To answer this question, first we need to listen to the experts. Compounding is one of the most powerful forces in the universe. Albert Einstein. My life has been a product of compound interest. Warren Buffett. Compounding is the magic of investing. Jim Rogers. So, what is compounding? Compounding is a process where the earnings from an asset, whether from capital gains or interest, are reinvested to generate even more earnings over time. This growth follows an exponential pattern because the investment gains not only from the original principal but also from the accumulated earnings of previous periods. That means inside compounding there is a very important ingredient, which is exponential growth, that can be explained as a pattern of data that shows greater increases with passing time, creating the curve of an exponential function. Unlike linear growth, where only the initial principal earns interest each period, compounding allows both the principal and its accumulated earnings to generate additional returns. To illustrate the power of compounding, consider a $10,000 investment in an account that earns 5% interest annually. After the first year, the account grows to $10,500, reflecting $500 in interest added to the original principal. In the second year, the account earns 5% on both the initial $10,000 and the $500 in first-year interest, resulting in a gain of $525 and a new balance of $11,025. The time value of money is the concept that a dollar today is not necessarily worth the same as a dollar in the future, whether that's tomorrow, next month, or years from now. In most cases, a dollar received today is actually more valuable than a dollar received in the future. But why is that? The key principle is that money received today can be invested to start earning returns sooner than money received later. It may seem straightforward, but the implications are significant. For example, if you had invested $100 in the S&P 500 at the beginning of 2009, you would have about $852.89 at the end of 2024, assuming you reinvested all dividends. This is a return on investment of 752.89%, or 14.92% per year. This exponential growth happens because of compounding, where interest is earned on both the original investment and the accumulated interest over time. So the answer to the present question depends on the return you can earn on your investments. Choosing $1,000 today over $1,100 a year from now implies a 10% return. If you can earn a higher return elsewhere, taking the $1,000 now is the better option. However, if 10% is the best return you can achieve at your preferred risk level, waiting a year for $1,100 is the smarter choice. Once you feel comfortable receiving the money later rather than now, you will get a bonus, but patience is the key. Any investment requires patience, but, in the end, almost all of them are worth it. Now let's answer question number 2. Would you rather have $1 million today, or a penny that doubles every day, for the next 30 days? Let's see the astonishing results of choosing one penny that doubles every day for the next 30 days instead of 1 million today. Believe me, it will work. Get the penny. Day 1, 1 cent, the journey begins with a single penny. Day 6, 32 cents. In just 6 days, its value has multiplied exponentially, demonstrating the remarkable potential of compounding. Day 15, $163.84, only $163. Did I make the right choice here? Day 19, $2,621.44. Amazing growth, but I'm starting to feel a bit nervous. Day 23, $41,943.04. It is a lot of money, but it's nowhere near the $1 million I would have been enjoying those 23 days. Day 26, $335,544.32. Now we're talking. Day 27, $671,088.64. I think I can believe it. Day 28, $1,342,177.28. And, here, we, go, over $1 million. Day 29, $2,684,354.56. Wow. This is getting crazy. Day 30, $5,368,709.12. Finally, on the 30th day, the penny's value doubles one last time, surpassing the $5 million mark. An unbelievable journey from a single penny to over $5 million in just 30 days. Can I say, I told you so? If you followed until now, you just learned the top investor's most powerful secret, the power of compounding, the magic of investing and multiplying the money in the same process. If that doesn't showcase the incredible power of compounding, I'm not sure what does. By simply letting my penny quietly grow, I ended up with an astonishing windfall of $4,300,000. Now let's answer question number 1. How many trades in the stock market do you need to become a millionaire? The previous example, on question number 2, showed that if you could make 100% profit on each trade, reinvesting all the profits, theoretically, you would only need 28 trades to become a millionaire, even if you started with 1 penny. But, as we know, it's not possible to find an asset worth a penny, and more importantly, it is almost impossible to achieve that kind of profit margin and consistency during 30 trades searching for 100% margin profit. Therefore, I have created an Excel sheet to show a more realistic way of trading, with a lower profit percentage and a higher initial capital, that show exactly how long it would take you to become a millionaire on each case. If you want to have access to the sheet above, please comment, "I want to become a millionaire." The link will be in the video description below. There I have created the model with different colors to separate a higher risk and lower risk, from 1% to 100% profit margin. As profit increases, risk increases. Therefore, since 1%, 3% and 10% are less risky, I have allocated $100,000 as an initial investment, and, for 30%, 50% and 100% profit margins, I have allocated only $1,000, since they carry more risk. As you scroll down the sheet, you will find out how many trades you will need to reach $1 million. The sheet shows that, with an initial investment of $1,000, you will need only 11 trades, with a profit margin of 100%, or only 19 trades, if you can make 50% profit margin, or only 28 trades, having a 30% profit margin. But remember, those are red and orange columns because are not easy to achieve and carry too much risk. Go for the blue color columns that are certainly more realistic, and do not take that long to reach $1 million. If you are consistent in your trading career, for example, if you manage to invest $100,000, then you will only need 26 trades with a 10% profit margin, or 79 trades with 3% profit margin, or 233 trades having a 1% profit margin, to reach $1 million, taking a lot less risk. Don't go away, because I have one last question. Would you rather have $10 million right now or $10 per second for the rest of your life? Let's look at this another way, because math is king. If I choose $10 per second, how much I would have? $864,000 every single day, $6,048,000 every single week, $12,096,000 over 2 weeks, $314,496,000 over the first year, $3,144,960,000 over the next 10 years. Well, more than $3 billion. Next time you will know how to do the math. Let me know what you think about this lesson in the comments below. And I see you in lesson number 2. Good luck and good profit. By Edward Cash Trader.